Hey everyone, welcome back to the channel. My name is Nate, and in this tutorial, I'm going to share everything that you need to know about dividend stock investing, how to get started. We're going to talk about some of the pros, the cons, some mistakes that you want to potentially avoid, how to buy dividend stocks, some terms to know, and then we're going to go really deep into it. So we're going to talk about things like how much does it take to live off of dividends, and then also some of my favorite dividend stocks as well. Now, let's go ahead and just get into this video. There's going to be so much information in this. I'm really trying to pack as much into this as possible. So as it is a tutorial, I do recommend taking out a pen, taking out a piece of paper, because it's going to be a bit longer, but I can promise you that if you stick through this video, you're going to learn quite a bit, and you're going to be able to take this information and use it for the rest of your life, hopefully to your advantage. Now, one more thing before we get deep into this video is, look, I'm not a financial advisor. I'm a guy on the internet. I'm passionate about this. I like talking about this. So please remember that all financial decisions that you make are solely up to you, and you are the person who makes those decisions. So just remember, there's a lot of risks with investing in any way whatsoever. So let's get started with this with first understanding. And by the way, feel free to skip around if you want to skip to certain parts of this video. I will leave timestamps down below and also some other resources down below, as well as some free stocks you can get with Moomoo. I think they're giving away like 15 free stocks at the moment. So I'll leave all of that information down below in the description if you want to get some free stocks. It's a pretty good promo, and I'm an affiliate with them, but we'll talk about that later. So what is a dividend stock? This is the really basics here, and then we'll go deeper as we go along in this video. But a dividend stock is simply, it's a distribution of profits by a corporation to its shareholders. So if you understand what a stock is, hopefully, you just own a piece of a company. Well, sometimes those companies are profitable. And when they're profitable, they need to figure out, what do they do with these profits? Do they keep them in the company? Do they spend them on like R&D? Or do they pay those profits back to the people who own the stocks? And that's what dividend stocks do. That's what companies who decide to pay dividends, they give that money, some of the profits, back to the people who own the company, which is the shareholders. So hopefully that didn't sound too confusing. It's actually a pretty basic concept. And if you didn't get it right now, don't worry, you'll get it in a couple minutes as we go on throughout this video. But yes, it's essentially when a corporation, they earn a profit, they're able to pay a proportion of the profits as a dividend to their shareholders. And then any amount that's not distributed as a dividend can then be reinvested back into the business, or they can use it for some other purposes that we will discuss on the next slide. Okay, so how do dividend stocks work? How does a company decide when to pay out a dividend? So the majority of companies in the United States will pay out a dividend on a quarterly basis. Now remember, not every company is going to pay a dividend. So not all stocks are dividend stocks. I would argue that the majority of stocks don't actually pay dividends. We'll use some examples as well in the coming slides here, but most companies are going to pay on a quarterly basis if they are indeed paying a dividend. Now, I've also seen ones that will pay on a monthly basis. Every single month, they'll send a cash distribution. This can either be through a physical check, which used to happen a lot. I remember like my grandfather used to get physical checks for some of the stocks that he owned on a quarterly basis. But most of them will actually just be directly deposited into your investing account. So we're in 2022, almost 2023. You're not going to see physical paper checks getting mailed out very often. So basically, for example, I own JP Morgan stock, right? And every quarter they pay me on a quarterly basis, so every 3 months. So you're going to get paid 4 times per year by somebody like JP Morgan for owning part of that company. And so the current dividend payment is public information. Usually every time a company has its shareholder meetings, which is usually on a quarterly basis, they say what they're likely going to pay in the next quarter for their dividend. And then it's typically, yes, directly deposited into your account. Here's just an old dividend from the Pennsylvania Railroad Company over 100 years ago, I think. So pretty cool. Or not even 100 years ago, from 1939. Okay, so going back to why dividends occur, because you always need to understand, why is somebody paying a dividend? There's no such thing as free money. It's coming from somewhere. And so when a company makes profits, they have to decide, what do they do with these profits? Now, the easiest one to do is to pay out a dividend, especially if it's sort of an established company. You tend to see dividend stocks that are older companies, ones that have maybe been around for many decades, and they've been profitable for many decades. And so they decide, hey, instead of trying to reinvest this money back into the business, we're going to pay these out as dividends. But there's other ways that companies can distribute profits or deal with profits. And something that's actually very common is something like share buybacks. So Apple has been doing this a lot lately. Meta has been doing this. A lot of big companies, especially in 2021, when things were going really well, companies were buying back their stock. Basically, they were taking the profits and buying up their own stock, so that what they did is they lowered the amount of shares in the pool and overall, helped the shareholders have more value because they ended up owning more of the company when they did share buybacks. Share buybacks have been super popular, especially the past decade or two. So many companies have been doing them. But you're not going to get direct cash payments when a company does a share buyback. You're actually not going to really notice it too much, except maybe you'll notice that the stock price might go up a little bit more on those specific days that they do those share buybacks. Other things that companies do with their profits are things like R&D, which stands for research and development, and then also sort of just retained earnings, or basically investing that money back into the company. So a lot of companies do this as well, which is important for growth, right? Let's say they make $100 million in profit. Now, if they pay all of that out in dividends, well, how are they going to do more R&D? How are they going to maybe build new products? So companies need to funnel some of their profits back into creating more profits in their own business. So those are just ways that companies can distribute profits. You want to make sure that companies aren't doing too much of one specific thing. And we will get more into this when we talk about how to select dividend stocks. But for example, if you see a company that's taking 100% of its profits and paying all of those profits out as a dividend, that actually tends to be a red flag because, they're not reinvesting back into their business. But at the same time, maybe perhaps if a company is only reinvesting back into the business and they're not paying out any dividends, sometimes, it's like, hey, we want some money back as the shareholders. So let's talk about some of the pros and cons of dividend investing. Definitely make sure that you stick around for the cons section in just a minute here, because a lot of people overlook some of the downsides, and I want to be very honest with you. My goal here is not to try to convince you to invest in a dividend stocks. My goal here is to try to give you a very unbiased idea of whether dividend stocks are for you or not for you. Because for some people watching this video, you're going to get to the end and realize, hey, maybe I don't want to invest in dividend stocks, and other people are going to say, yes, this is perfect for me. But why dividend investing? What are the pros of this? What are the benefits? So first of all, passive income. I think this is a pretty great word. Everyone loves to have passive income. And I do, in fact, get this nearly on a monthly basis. So I own stocks that I bought 10 years ago, ones that I bought 5 years ago, that every quarter will pay me in passive income. In fact, let's take a look at JP Morgan stock, and I'll show you this right here. JP Morgan pays $1 per share per quarter for owning this stock. So if you own 100 shares of JP Morgan, they're going to give you $100 every quarter. Now, of course, they can change this if maybe if their profitability falls, they could lower this dividend in the future, but they tend to increase it over time. And so if I own 100 shares of JP Morgan, I'm going to get $1 per share every single quarter. So every 3 months, JP Morgan's going to pay me $100. Hey, that's pretty cool. That's passive income. I can pay my Wi-Fi bill with that. I can, pay for maybe some of my gas or something else, my Netflix subscription and some other stuff with that by owning 100 shares of JP Morgan. Now you can see as this scales up how cool it is. Like let's say that you own 1,000 shares of JP Morgan. Now you're getting $1,000 per quarter. If you own 10,000 shares of JP Morgan, you're getting, what is that? $10,000 per quarter, $40,000 per year in passive income. You don't have to go to work. You don't have to do any of those things. You're just making money from JP Morgan paying you out as a dividend. And of course, there's a lot of risk with that. Like, they could lose profitability and they could lose that dividend, or the stock price could go down. But passive income is probably the best aspect to dividend investing. It also tends to be seen as safer than other risk assets. Now, of course, you also want to be careful with this, because I have bought dividend stocks way early on when I first started investing that went to zero. They went bankrupt, okay? And so it's not totally risk-free, but they are seen as relatively safe among stocks, especially if you're investing into like the blue chip companies, because a lot of these ones are like Coca-Cola and Pepsi and Home Depot and Walmart, companies that you're probably pretty familiar with and are seen as relatively stable. They're not penny stocks that are, having these massive swings. It's not like cryptocurrency or NFTs where they're going up 100,000% and then they're crashing down 99%. They tend to be relatively stable. Okay. Some other pros to dividend investing, look, they tend to be somewhat inflation resistant as well because they're paying out those dividends. They tend to be goods that are in certain industries that are somewhat inflation resistant. Just as kind of a basket, we're a bit generalizing here. Also, yeah, less volatility, like I said, with the risk tends to be less volatility than those, tech stocks. And then also, it's really preferred among older demographics who desire some type of income. So, maybe you just want to have $20,000 a year to live off of. You don't want to have to go into work. If you're 70 years old, dividend stocks could be an option because they are giving you that income that is relatively reliable. Also, another great benefit to dividend investing is it can give you tax advantages. It just depends what tax bracket you're in. For example, for me, it's not advantageous to have dividend stocks because I end up paying a lot in taxes based on certain tax brackets. But if you don't have a high income, you can actually, not pay very much taxes on your dividends that you're getting on a quarterly basis. Like I said, though, it depends on your bracket. So it can be a pro, it can be a con, depends where you stand. And then the other cool thing about it as well is something known as a dividend reinvestment program. Most brokerage firms have this, and it's really cool to see how many shares of a company you can acquire. So I just bought a couple hundred shares of a company last year, and now I own like almost 400 shares from it because it's continuously compounding. So the dividend reinvestment program, basically they take your quarterly dividend that you might be getting, and instead of just giving you cash, they take that cash and they buy more shares of the company. So that's like, if you had 100 shares of JP Morgan and they give you $100 in a quarter, well, you can almost buy a full share with that. So now after a quarter, you might have 101 shares. And then the next quarter, it compounds even more. And then you'll have 102 shares, and then you'll have 102.1 shares, and 103.2 shares. And it starts to add up like that. And, you blink, 20 years go by, and suddenly you have thousands of shares after just buying 100 shares to begin with. And that is something like the dividend reinvestment program that most brokerages do offer. So those are all the great things about dividend investing. Now let's talk about some of the downsides to it, okay? And these are things that I don't really see a lot of people talking about. They just kind of brush over them, but they're very important, okay? Taxes for high earners. Look, if you're making over $100,000 a year, dividend stocks might not be the right move for you. And that's because you're going to pay taxes on that every single year, and it compounds. So, if you're paying 20% tax on all those dividend payments that you're getting every quarter, that compounds over a long period of time. Whereas if it was just, if you had that in regular growth stocks, maybe you would have a better return over the long term. Of course, at the end of the day, it always does depend on the companies that you're investing into. Also, another downside to dividend investing is that sometimes you're actually not super diversified because it can be a bit concentrated in specific sectors. So for example, I think if you look from maybe 2010 to 2020, a lot of dividend stocks actually underperformed things like tech stocks because they were a little bit more slow growing. And so like they tend to be in things like consumer defensive and like energy and some other stuff like that, where it is a little bit more concentrated. And then also, the other downside to dividend investing is that you usually, I would say on average, will have slower share price growth because going back to what we talked about, like what a company does with their profits, if a company's paying out a lot of their profits in dividends, they're just giving cash back to their shareholders, then they're probably not reinvesting as much into the business. And so the share price sometimes might not grow as fast as other growth stocks, like what you might see with things like Google and Apple and Tesla, who are reinvesting most of their profits straight back into the business. So slower share price growth, can be a big factor, right? If you have a tech stock that's growing 20% per year and you have a dividend stock that's only growing 5% per year, but it's giving you 5% dividend, what's better? You have to make that decision for yourself. Do you want those cash payments or do you just want that growth? It really does depend, okay? So those are some of the downsides that I want you to be very aware of. Now, how do you actually go about buying dividend stocks? It's pretty easy. You can do this on most brokers. So the one that I use is Moomoo. Right now they're giving away 15 free stocks. This is a little promotion here, so I'm just, a little ad spot basically. But if you want to get 15 free stocks, you can go check out the link down below in the description. Sign up for Moomoo. You can buy dividend stocks on there. I don't know if they're still going to be doing this promotion when you're watching this video, but if they are, I will have that link down below. You get some free stocks. I think it's a pretty good option. You can scan this QR code right here, or you can just go to the link in the description. So let's talk about some terms that you want to understand. We're getting into the nitty gritty here. This is the stuff that you won't see on a lot of other channels, but it's something that, if you understand this, it's really going to help you out a lot in finding the best dividend stocks to invest into. Because you don't want to just go in and buy a bunch of random dividend stocks that you read on like some random website, because this is how you're going to get wrecked. This is how I got wrecked when I first started investing, because I went onto some blog and I read, top 5 stocks, and I just bought all of them blindly, and most of them went bankrupt. So be careful, right? You want to actually know what the hell you're investing into, and make sure that you're doing some due diligence here. So let's talk about some of these terms. First of all, we have dividend yield. So the dividend yield is basically the percentage yield that you're going to be getting on an annual basis from a stock. Now you'll notice that this actually fluctuates, because this is not how companies determine like how much they're paying out. Companies will say we're paying out a certain dollar amount per quarter. So JP Morgan pays out $1 per quarter. But then the dividend yield is calculated by taking the annual dividends per share and dividing it by the price per share. So basically in this case, you're taking the annual dividend payments of say $4, you're dividing that by $133.29, and you're finding out that the annual dividend yield at the moment, at this current stock price, is 3%. So you're yielding 3% per year with JP Morgan stock at this current stock price. Now, this dividend yield will fluctuate based on the stock price and also based on the dividend payments. So if this stock price gets slashed in half and JP Morgan tanks and they go down to whatever, $70 a share or $65 a share, if that happens, then the dividend yield will actually spike up if they're still paying the same amount of dividend of $1 per share. The dividend yield might spike up to maybe 6% if the stock price gets cut in half, and vice versa. If the stock price doubles and it goes to $266, then the dividend yield might go down to about 1.5% if the quarterly payment stays the same at $1. So the dividend yield is nice to just look at very quickly, but at the end of the day, you're going to want to look at actually the quarterly dividend payment, how much they're paying out there. So that's the dividend yield. You're going to see this thrown around a lot, but it does help you give that quick and dirty number. I would say most dividend stocks are going to be in the range of somewhere between 1% dividend yield up to about 10% dividend yield on an annual basis on how much they're paying out in dividends. Now, you want to be careful, and we'll talk about dividend traps later on in the video, but you want to be careful as to how high of dividend yields you go for, because sometimes these can be traps. And if you see something that has a really high dividend yield, it can mean that it's unsustainable, the company's not capable of actually paying it out. So don't be lured into just thinking that this higher number is going to be better. 3% tends to be a pretty safe number. This is the one that I like to go for. But yeah, just wanted to make that very clear there. Okay, so now let's talk about dividend payout ratios. And this is basically just your dividends divided by net income from a company. And this is also important to realize the health of a company and the ability for that company to pay out dividends over a long period of time. So there are companies that will have high dividend payouts, but they're not actually reinvesting any money back into their business. They're just paying out all this money, and they're barely staying afloat, right? So looking at this little diagram here, right? So let's say that the net income is $10,000. They might have retained earnings of $8,000 that they keep in the business, they use for expenses, they use for R&D and growing the business internally, and then they might pay out $2,000 in dividends. Well, that would give them a dividend payout ratio of about 20%. Now, for this number, I would say anything that is getting over 40 to 50% in a dividend payout ratio is a bit of a red flag, because it means that, once again, the company's not reinvesting, they're just giving out all their money to their shareholders, and then they're not putting it back into the company. And it can just be a little bit concerning in my personal opinion, because I've seen this happen with companies like General Electric, for example, or a number of other ones where they're not focused on like, hey, let's make sure that we keep our moat. Let's make sure that we are able to sustain this business and continue to grow it. and they kind of lose their footing and the whole thing comes crashing down. I've seen it happen before. So once again, don't be lured into the super high dividend payout ratios. You want to find that sweet spot. I like to find things under 40%. If they're paying a 3% yield and their dividend payout ratio is only 10% or 20%, that tends to be pretty good. That's something that I like to look for. Okay, so what's the total return? The total return is basically you're calculating not only the stock price increases over a period of time, but also factoring in the dividend payments as well to calculate your total return. So for example, here's JP Morgan stock. Looking at the past 10 years of payouts from this company, we're not only just looking at the starting price and the ending price, right? So JP Morgan 10 years ago, they're at $40.73. Today, they're at $133.84, right? Now, you also have to factor in the dividend payments to actually calculate the total return of that stock. So if your initial investment was $10,000, your investment value today, $43,000, but then you also have dividends collected that was $7,436.50. So when you add all of that up, that's how you actually get the total return. Now, compare something like that, a dividend stock, to maybe Tesla, which doesn't pay out a dividend. You would look at the past 10 years, but they don't pay out a dividend, so you wouldn't add in that extra $7,436. So looking at the total return will help you get a better idea as to the company's true returns over the past decade or over the past any period of time, because you're factoring in everything, including interest and other things, rather than just looking at the stock price over a certain period of time. Okay, and just a couple other terms that I think you should really be aware of is things like understanding revenue and looking at revenue growth. Of course, you want to see companies growing their revenue. I really like these charts that Google Finance has available. Actually, you can just find this pretty easily on Google Finance, but we're looking at revenue growth for JP Morgan, right? We see this on an annual basis. They've been growing their revenue, and then also their net income has been growing. And then, things like EBITDA, which is earnings before interest, taxes, depreciation, amortization. There's a lot of things you can get really in the weeds with, and I do recommend that, but I don't think we're going to cover all of these in this video right here because it would take 10 hours and I think it'd be pretty boring. We also do have some videos on that, so if you want to learn how to analyze a stock, I have like an hour-long video. I'll leave a link to that down below. If you want to understand things like income statements and balance sheets and cash flow statements, you're going to want to probably just watch that video to learn about it, but there's a lot of other information that would be very helpful for finding these dividend stocks. Okay, so what are some key factors for picking stocks that pay dividends? So here's some things that you want to look at. First of all, long-term profitability and earnings growth. You want to really focus on this. I think too many people, especially when first getting started investing into dividend stocks, they focus on how much the company pays in a dividend. That's like the big magnet, that's what they look at, and they don't focus on profitability. Look, I don't look at dividend payments as much as I do as profitability. A dividend is basically, to me, like a cherry on top, right? I want the sundae. I want to make sure that this is a really good company. And if I get a cherry on top with a 3% yield on a dividend, that's great. It's beautiful, but it's not the number one thing that I go for, okay? So focus on companies that have long-term profitability. They're growing their earnings. They have increasing cash flow coming in every year, right? They're more and more profitable every year because then it's going to give them that room to potentially pay out a dividend or increase their dividend payments in the future. Having relatively low debt levels is something that I really look for, especially in this environment, right? Going into 2023, companies with high levels of debt, it's going to be hard to pay really solid dividends if you have $10 billion in debt, like overhanging, right? It's going to be difficult because the company's goals, if you have a lot of debt, will probably just be paying down the debt, and they won't be focused on paying off dividends. They might lower their dividend payments. They might slash them altogether. We saw this happen with General Electric. They had so many problems. We saw this happen with AT&T, right? They had a lot of debt. They had to slash their dividend. So you want to make sure that companies have pretty low levels of debt, but not too low. If a company doesn't take on any debt at all, it could also be a bit of a red flag. Like, hey, they're not using the tools available to them. Why are they not reinvesting? And so, sometimes debt can be good, but you don't want too much. Strong cash flow. I think this is pretty much a no-brainer, but you want to see this cash flow increasing year over year because this is what, at the end of the day, is going to be where they, get money from and are able to actually pay out in dividends. I've seen some companies that are profitable But when you look at their cash flow statements, they don't have any cash actually flowing in. It's all like accounts receivable and like goodwill and all these different like weird things that they're doing on their financial statements, but they don't actually have cash coming in the door. So make sure that the company has lots of cash coming in the door so that they can sustain those dividend payments. Also, some really important key factors for picking stocks is understanding sector trends. So if you study, demographics, for example, you know that baby boomers are getting a bit older, right? And baby boomers were the largest generation in the United States. We have tens of millions of baby boomers, and most of them are getting older, right? And so they need healthcare. This is why a lot of healthcare companies have been doing extremely well in the past 10 years because baby boomers are getting older. So understand sector trends, right? Like what's happening with the steel industry, what's happening with the energy industry, right? If you caught dividend stocks last year, when you understood the price of oil was probably going to double, you could have doubled your money in the past year on things like ExxonMobil and Chevron and a lot of other oil companies. So understanding sector trends is something really big that I do. Like, for example, I loaded up a lot on Air Product stock last month, and it's up like 30% this month already. And it's a dividend stock. It pays me 3%. I love it. One of my favorite companies. But it's because I study sector trends and I try to understand where the markets are going. And then also things like having a low to medium payout ratio. So we already talked about that. And then also something that I like to do to actually find these stocks is to use the stock screener on Moomoo. It's pretty great. It's very in-depth. So you can check that out down below in the description if you would like to. So now let's talk about Dividend Aristocrats. These are highly respected companies, companies that have been increasing their annual dividend per share for at least 25 straight years. So these are seen as pretty reputable companies in terms of reliability on dividend payments and increases in their dividend payments. So the factors that must be met in order to become a dividend aristocrat as a company are these here. So companies, they must be a member of the S&P 500. We have a lot of companies in this. They tend to be relatively blue chip. And they must have increased their annual total dividend per share for at least 25 straight years. I'm not going to lie, that's older than me. So to be a dividend aristocrat, they have to be increasing their dividend since, 1997? A pretty long time in order to fall into this dividend aristocrat field. And then also, they must have a float-adjusted market capitalization of at least $3 billion. So they can't be penny stocks. They can't be worth like $200 million. Have to be at least $3 billion. And then they must also have an average daily trading volume of at least $5 million. If they fit all of these different criteria, then they are considered to be a dividend aristocrat and relatively safe. Now, I say relatively because things have fallen. We've seen dividend aristocrats fall from grace. And there's a few that come to mind for me right off the bat, but I would say things like General Electric, AT&T this year has gone down a lot. And then other companies, like Sears, or we've seen, what was the other one? Kellogg and Heinz. We've seen some that really just have had a pretty tough time, and they're no longer dividend aristocrats because they weren't able to increase their dividends for that period of time. Okay, so where do you find the stocks? There's a couple different options. Stock screeners I think are great. Like I said with Moomoo, Finviz is another great stock screener that I use personally. It's just a random website that I've been using for years. And then also, sometimes I use the Motley Fool to find stocks. So the Motley Fool, it's a service that, they talk about a lot of different stocks. I would say be careful with it. Don't take everything like fully for how they say it. Take everything with a grain of salt, basically. And so sometimes they'll, send out some like little clickbaity of some stuff, like buy these 10 stocks right now, these 10 dividend stocks. But I still like to read through it. So I'll leave a link down below for the Motley Fool as well, because sometimes they do have some good information. Just don't buy stocks entirely based off of what they say, but just use it as like a resource for like understanding some stuff. So the Motley Fool, it's basically just like a newsletter. It's also a website. You can get a lot of information, and I will leave that link down below to them as well if you want to check them out. So is dividend investing right for you? So I think the big three questions that you want to ask yourself is, first of all, do you need additional income now? For me personally, I don't, right? I have businesses, I have income that comes in every year from actually working. And so I don't really need a lot of dividend income right now. And so I have dividend stocks. I have a decent sized dividend portfolio, but it's not my main thing because I don't need cash flow and passive income right now. I would rather invest into growth stocks. So understanding the differences between dividend and growth stocks is really important. Okay, if you're young, you're working a lot, and you're in a high tax bracket, might not be the best move to like entirely focus on dividend stocks. But then in my retirement account, I do have dividend stocks because that stays in there and I don't have to pay taxes on that every year because it's in my 401k. That's me personally. You know, not everyone's going to fall into that basket. Some people are going to love dividend stocks and they're going to get deep into it and they're just going to go all out into it. And I think that's totally cool. I used to do it as well. And I probably will a lot when I'm ready to retire. I'm going to just go all in on dividend stocks when I'm ready to retire. But right now it's, you know, makes up a portion of my portfolio, but not all of it. So you need to really ask yourself if dividend investing is actually right for you. Okay, so we're talking about 3 more things here. Mistakes to avoid. Then I'm going to share some dividend stocks that I really like and ones that are in my portfolio. And then I want to share how much it would actually take to live off of dividends if you didn't want to have a job and just totally live off of that. So first of all, mistakes to avoid. Dividend traps, be careful with this. Don't chase the yield. If you see a yield over, I would say, 8% dividend yield, be careful. Immediate red flag. If you see something paying a 20% dividend, be very careful. Read through their balance sheet, read through their cash flow statements, and you're probably going to find that it's a falling knife, that it's not sustainable, and that the company is likely headed to bankruptcy, or that they're going to have to cut their dividend altogether because they can't afford to keep that up and pay a 20% dividend. This is the biggest mistake that I made when I first started investing. My first couple stocks were companies that went bankrupt because I chased dividend yields, I went for high dividends, and the companies performed very bad, okay? So watch out for those dividend traps. Focus on growth in earnings per share, focus on revenue growth, focus on cash flow growth, but not so much on those high dividend yields. And those other red flags, things like if the company's not reinvesting back into, doing that research, doing that development, and really trying to, expand, hire more employees, bring on new projects, and try to grow revenue, that's something you want to be careful with. And then, of course, going down with a sinking ship. Look, if a company's going downhill and you know it's going downhill, don't be afraid to cut your losses and just get out. I do this all the time. Because I have a saying, and I'm sure I didn't make this up. I'm sure I learned it from like Warren Buffett or somebody. But if you have to treat every stock every day as if it were a buy today. If you wouldn't buy that stock today, why are you holding it? Okay, and you got to ask yourself that, because I've seen people hold dividend stocks and it's going down, it's going down. You can tell it's like the writing's on the wall, but they don't want to believe it because they're already down 20% and they just ride it all the way down to bankruptcy. I saw it happen with Sears. I saw it happen with so many companies. So please, if you see something happening, just treat everything like it's a buy today. And if you wouldn't buy it today, then why are you holding it? You got to ask yourself that question. Now, as I said earlier, I have a decent sized dividend portfolio. Here's just a handful of the companies that are in my portfolio. And so Air Products is probably one of the biggest ones. I've just liked this company for a long time. I grew up in Pennsylvania, so this company's based in Pennsylvania, so I've always seen them in the news. So it's one of the first stocks that I started buying. And right now they're paying around a 3% dividend yield. It is a very boring company. It's in industrial gases, so they're selling like hydrogen and helium and nitrogen and oxygen, really boring stuff, but it's a company that I think is pretty stable. And by the way, of course, look, this is not a recommendation to buy any of these stocks because they could go down and you could lose money. So do your own research on this. These are just some of the ones that I like personally. Companies like JP Morgan, Pepsi, Walmart, Waste Management, Philip Morris, which is actually a tobacco company, but they're getting into other things, trying to shift over away from cigarettes and other things. They're producing so much cash right now. They're reinvesting a lot of that, but they also pay out a lot of dividends. And then Nucor as well, which is actually a steel company. And you'll notice amongst all these companies, they're pretty boring, right? It's not like Snapchat, it's not Twitter, it's not some, really cool, edgy, futuristic company. These are just core companies that are sort of the backbone of the world in a sense, and those tend to be the ones that pay out decent dividends. I would say just roughly looking at this, most of these here pay out somewhere between 3 and 5% yield. Some of them might be around 2%. I think Waste Management is 1.5–2%. But those are some of my favorite dividend stocks. And if you want to find more, you can look on stock screeners. So The last question here is, how much would it take to live off of dividends? And to do this, I'm going to just take you to a site that I use all the time. I'm always plugging stuff into this site. I don't have any affiliation with it. It's just something I use a lot. Is to find out how much it would take to live off of dividends. So if you just go to the description below, I'll leave a link to the dividend calculator, and you can look at it. It's on tipranks.com. But you can type in stocks. Like let's look at something like Philip Morris stock, okay, which is the tobacco company that I was talking about that I own, right? So let's say you have 100 shares of this stock. This is $9,845, holding period for, let's say, 20 years. And you are reinvesting those dividends. You can calculate your returns. And you can see that every year, your annual dividend, if you had 100 shares, it's going to be about $500. 20 years later, about $1,300. So you're going to need more money to live off of this. Now, from what I've seen and what I would estimate is if the average dividend yield is about 3% and you want to live off of $30,000 per year, you would need to have about $1 million in dividend stocks to get $30,000 per year in cash flow. So, it's not pretty in the sense that like you can't have $10,000 and live off of dividend stocks. You're going to need to acquire a pretty large nest egg. And the way to do this is just slow and steady. Slow and steady wins the race. If you're socking away, let's say you are making an annual contribution of, say, $5,000 per year into this, you calculate your returns. So you still need to do a lot more than this if you want to live off of dividends. But you can see 20 years later, you're making about $10,000 a year from this by socking away $5,000 a year into a stock like this. So you have to start just messing around with this dividend calculator. Let's say you start off with 1,000 shares and you're able to invest $15,000 a year into some dividend stocks. And then you can see by the time you get 15, 20 years later, you're earning, close to $30,000 per year in dividends. So this can be sort of a retirement plan in a sense. So I do recommend just like mess around with this calculator and you can see how much you would be getting in yields on this, and you can combine stocks. You can do some really cool things like that. But generally speaking, you can kind of estimate about 3% dividend yield for most stocks that are stable. And so if you have $500,000 in dividend stocks, you'd probably be getting somewhere between like $10,000 and $20,000 per year. And if you had $1 million in dividend stocks, you'd probably be getting somewhere between like, $20,000 and $30,000 to $40,000 per year. And if you had $10 million in dividend stocks, you could be making $300,000, $400,000 a year in dividends and live off of that. And that's kind of my goal. So just being honest, like that's my goal. I want to build up to $10 or $20 million and then just be able to live off of a couple $100,000 a year from my dividends and have truly passive income. So hopefully you found this video to be helpful. It's a long journey. It takes time to build up. I've been doing this for over a decade. I'll be doing it for hopefully many more decades to come. And let's check back up in 20 years, in 30 years. Feel free to reach out to me on Instagram, reach out to me on Twitter if you would like. And don't forget to check out Moomoo to get some free stocks, get you started a little bit. It's a great company. I really do like them. I use them a lot. So thanks for watching this video. I hope you found it to be valuable. Make sure you subscribe to the channel if you haven't done so already. Drop a like on this video, and I'll see everybody in next week's video.